Dovish Central Banks and perceived progress on the trade talks have fueled an impressive rally year to date. But with valuations no longer cheap, some sort of consolidation would be healthy now, as the macro data will continue to disappoint, particularly in China and the Eurozone, but even in the US. So we would not chase equities here, but rather add selectively on dips, as the Fed's delivered QT, along with a probable rate cut in Q3 of this year, and China's targeted fiscal and credit stimulus should support some sort of modest recovery in the second half of the year. In the meantime, given stretched technicals, our chief strategist, Andrea, has further de-risked his portfolio. The key, though, is to monitor whether the VIX can continue to remain below 15 in order to give a signal that the peak of the cycle remains ahead of us. US markets were correct in Q4 to price in a sharply decelerating US economy from the peak in Q3. But our US economist Steve Blitz has always argued that Powell's Fed is qualitatively different from previous incumbents, and that he would be much more proactive in response to deteriorating economic data and to forestall any further yield curve inversion. With the Fed delivering a QT taper and a probable rate cut later in the year, we're seeing a return to a form of low-level stealth QE, which in turn should reduce real yields and raise inflationary expectations. And depending on how the QT taper is ultimately affected, maybe some combination of operation twist or switch, it should end by the third quarter of this year. This should also mean that term premia nudge higher, particularly as the distortive effects of the ECB's QE have now ended, and the yield curve after initial flattening should eventually steepen. Much more importantly, though, we continue to believe that the likelihood of a recession either this year or next remains extremely low. Indeed, should growth re-accelerate at the back end of this year, 2020 may be more problematic for the Fed in terms of dealing with more traditional late-cycle inflationary pressures. Our China guru, Bo Zhang, notes that China has now embarked on what he calls measured easing, that is to say, targeted fiscal and credit stimulus to combat the slowdown and the deflationary collapse of PPI. However, the key point here is that there will not be a major reflation to bail out the rest of the world, as in recent cycles, as deleveraging has simply been put on hold rather than cancelled. Now, although China is moving into a cyclical and possibly structural current account deficit, much more effective controls on capital outflows, along with the new trend-changing surge in portfolio inflows, means that the Yuan should now be stable. This represents an evolved change of view from last May, when the risks of a flat-out trade war were much greater, through to our November past peak trade war call, to the current consensus expectations that President Trump needs a political win and that a fudged compromise of some sort will suit both sides now. It also probably reflects the general view that as part of any trade deal, China will have to commit to keeping the yuan stable. However, none of this undermines Larry Brainard's and Jonathan Femby's longer-term thesis that the tech and IP trade war will rumble on indefinitely, leading to the emergence of regional trade blocs and supply chain reconfigurations. In the Eurozone, we remain considerably below consensus for the outlook for growth, as Sweatersin's work in global financial trends highlights an alarming recent build-up of precautionary savings, both by households and corporates, neither of which augur well for consumption or capex. So Charles Dumas argues more vehemently than ever that much greater fiscal stimulus is required, given how badly boxed in ECB President Draghi is. And although TLTROs have been delivered as we anticipated, Dario Perkins points out that these will be little more than a palliative, as it looks like the ECB will now spend an entire economic cycle with its policy rate stuck at the lower bound. Within emerging markets, Larry Brainard and John Harrison still maintain an overall neutral view, but continue to advocate judicious profit-taking in the two leading markets year to date of China and Brazil. Of course, any sort of trade resolution will probably give Chinese equities a final fillip, but data will continue to disappoint for the next few months, and we sense that the market is too optimistic about the eventual efficacy of the stimulus when it is delivered in the second half of the year. And in Brazil, our LATAM team of Elizabeth and Grace highlight that the Bolsonaro honeymoon is now waning and the economic recovery is still disappointing. Of course, the upside here remains how the eventual pension reform is delivered and to what extent. In India, Shamita continues to be concerned about the political cycle, the fiscal race to the bottom, and the RBI's credibility given recent shenanigans. Lastly, given the reinforcing global disinflationary trends, EM carry probably remains one of the most attractive risk-adjusted investments, and within that we would highlight Mexico, Indonesia, and Russia.